Are you looking to build a retirement portfolio? Retirees have different challenges in their investment planning than other groups of investors. Investors in or nearing retirement might have to consider income replacement as a key component of their investment decisions. You need income in retirement. After all, retirees no longer have a regular paycheck from working to rely on. In addition to traditional sources of retirement income, retirees can boost their retirement paycheck, through dividend stocks. And these companies pay shareholders regular income just for owning the stocks. But not all stocks pay dividends. But consistent payments from dividend stocks can be a valuable source of income for retirees. Of course, investors interested in purchasing individual stocks should make sure that they've researched each company to ensure that it's financially healthy, with a strong business model, and has plenty of future potential growth. Which brings me to Sure Dividend. Since you're looking for information on stocks for your retirement portfolio, I wanted to introduce Sure Dividend. Sure Dividend helps investors like you and I find high-quality income securities for their retirement and financial freedom portfolios. And the Sure Dividend newsletter analyzes their top 10 high-quality dividend growth stocks each and every month. It's an excellent product which I use myself to research companies for the videos that I create for this channel. So if you'd like to support the channel, I'd invite you to check out the link in the description below. And by the way, go ahead and hit the subscribe button. That way you'll never miss any of the future videos. And stay tuned, because I'll be giving you a promo code for a $41 discount off the Sure Dividend newsletter. Alright, so without further ado, let's get right on to it. The following 10 stocks offer dividend safety, a strong balance sheet, a sustainable payout, and in some cases they even offer a high dividend. As a result, they appeal to investors looking to build a retirement portfolio. First up, we have Oklahoma-based OneGas, one of the largest publicly traded natural gas utilities in the United States. The company provides natural gas distribution services to approximately 2.2 million customers. OneGas currently yields just over 3% and should make a great addition to any retirement portfolio in its early stages, as this company offers compelling income and growth prospects. The company has a dominant market share in 2/3 of the states that it operates in, and the company should be able to continue to gradually grow its net income thanks to population and customer growth, and of course through base rate increases as approved by regulators. Increased profitability is also being supported by economies of scale kicking in as the company expands its distribution network. In fact, over the past 7 years, earnings per share have grown on average by 9.3% per year. That's a lot. Dividend growth investors will also note that the company has raised this dividend on average 15.6% a year over the same period. I mean, they can do this by combining predictable rate increases, which management expects to be between 7 and 8% through 2025. Also, earnings per share are also expected to grow between 6 and 8% over the next 3 years. So it's natural that management has targeted dividend per share growth of between 6 and 8% over the same period. Next up, we have realty income. When investors like you and I look at companies for our retirement portfolios, it's essential to focus on owning the best names in the market, especially since you'll need to rely on that income for retirement. What I love about realty income is that they're one of the few companies that pay a monthly dividend. It's true. And if you like the idea of getting cash dividends each and every month, go ahead and give me a like on this video. Alright, so realty income can do this because, well, they're dominant in their industry and they can navigate challenging economic conditions. And you can see this, they have a long history of both paying and raising dividends. Realty Income is a real estate investment trust, or a REIT, that specializes in single-tenant standalone properties, a highly fragmented industry, making it ripe for consolidation. And following a series of acquisitions, which including spinning off its weaker office space unit, the trust has nearly 11,300 properties in its portfolio, a footprint that's largely unmatched by its peers. Realty Income operates a highly diversified business model, which includes nearly 1,100 clients spread across 70 different industries. And no client accounts for more than 4.1% of the portfolio, and no industry contributes more than 10% of its annual revenue. So it's really well diversified. And the trust has properties in every US state and recently expanded to the UK and Spain also through a merger. Realty Income has declared more than 620 consecutive monthly dividends since the trust went public in 1994. And the company has also raised its dividend more than 114 times over the last 26 consecutive years, making it one of only 3 REITs that qualify as a dividend aristocrat. And by the way, if you want to know more about dividend aristocrats, check out this video. Alright, so the trust's dividend growth streak is likely to continue as its projected payout ratio for 2022 is around 75%, and it's below its 10-year average payout of 84%. Shares of Realty Income currently yield 4.2%, and for those of you that are in to know, that's nearly 3 times the average yield of the S&P 500. Next up, we have Parker Hannifin, a diversified industrial manufacturer specializing in motion and control technologies. Founded in 1917, today the company has a market cap north of $30 billion and annual revenues of over $14 billion. Parker Hannifin has an exceptional dividend growth record and has raised its dividend for 66 consecutive years. And for those of you that know, any company that has raised its dividend for more than 50 years in a row gets a place on the best of the best group called the Dividend Kings. Now, Parker Hannifin has achieved its admirable dividend growth record thanks to its consistent earnings growth. Thanks to a series of acquisitions during the last decade, the company has doubled its earnings per share from $7.45 in 2012 to $15.04 in 2021. And even better for shareholders, business momentum has accelerated in recent years. And most notably, the company has exceeded the analysts' earnings per share estimates for more than 20 consecutive quarters. And this is a testament to the strong business momentum of the company and its reliable growth trajectory. Looking forward, Parker Hannifin is currently acquiring Meggitt, a global leader in aerospace and defense motion and control technologies, for $8.8 billion in cash. Meggitt offers technology and products on major every aircraft platform and has annual revenues of $2.3 billion. No doubt, if the acquisition completes, and it should, as they just got clearance from the UK government, the transaction is likely to prove a major growth driver for the company. Next up, we have Medical Properties Trust Incorporated. They're a self-advised real estate investment trust formed in 2003 to acquire and develop net leased hospital facilities. Right now, the company is one of the world's largest owners of hospitals, with roughly 440 facilities and 46,000 licensed beds in 10 countries and across 4 continents. And the company is known as a dividend challenger with 9 consecutive years of dividend growth. The company has a 5-year compounded annual growth rate of 4.3%, and they've announced the most recent dividend increase in February 2022, when the company announced a 4% dividend increase. And today, the company currently pays an attractive dividend yield, it's pretty high, of 7.1%. It's actually one of the highest on this list, and much higher than its 5-year average of 5.9%. Next up, we have one of my favorites, 3M, a leading global manufacturer that was founded way back in 1902. They have operations in over 70 countries and a product portfolio with over 60,000 items, which are sold to customers in more than 200 countries. These products are used every day in homes, office buildings, schools, hospitals, and so much more. And 3M has paid dividends to shareholders for over 100 years. 3M's leadership has provided 2022 guidance and sees organic sales growth of between 2 and 5%, as well as earnings per share of between $10.75 and $11.25. So the company is growing, and the earnings per share is estimated to grow around 5% over the intermediate term. The company is currently prioritizing their investments in large, fast-growing sectors across the globe. And some examples are automotive technology, home improvement, personal safety, healthcare, as well as electronics. Now, 3M's technology and intellectual property are its most important competitive advantages. In fact, the company's growth is thanks to prioritizing research and development. Do you know 3M spends 6% of its sales, which is about $2 billion annually, on research and development? And these unique advantages have laid the foundation for 3M to raise its dividend for 64 consecutive years, year after year. Wow, imagine going to work and getting a raise for 64 years in a row. This is how 3M rewards its shareholders. And give me a like if you like that idea. And if you're wondering how much the dividend has grown, well, in the last 10 years, its dividend has grown at a compound rate of nearly 10% a year. Today, 3M pays an annual dividend of $5.96 at the current share price and has a high yield of 4.1% with a payout ratio of just 54%, which makes it pretty safe. And it's expected that the payout ratio is actually going to decrease in future years. Actually, as I said before, I think 3M is probably my favorite stock on this list, certainly in the top 3 anyway. Next up, we have Innovative Industrial Properties Incorporated, the only publicly traded REIT that specializes serving the U.S. cannabis industry. The trust had a massive head start in this extremely fragmented industry, and its portfolio is growing fast. For example, the company has seen its portfolio grow from just one property in 2016 to over 100 today, with 28 different tenants in 19 states. And the trust has been able to grow more than a $250 million run rate in revenue as of the first quarter of 2022, and analysts see so much more on the horizon. And today, the company offers an impressive 7.8% dividend yield, the highest on this list today, and they've raised their dividend more than 10 times since 2017. All right, so next up, we have another favorite of mine, Verizon Communications, one of the largest wireless carriers in the country, with a network covering over 300 million people and about 98% of the United States. Now, many people might see that Verizon is a boring stock, but look, Verizon has shown some impressive results. For example, take between 2011 and 2021. Verizon has grown its earnings per share by 9.6% a year. However, over that same period, the dividend per share grew by a compound annual rate of around just 2.5%, meaning the company's payout ratio has actually declined substantially over the time frame, and that's a good thing. Today, The dividend payment makes up less than half of its earnings, and that allows for a decent yield while allowing the company to reinvest in its business, keep a strong balance sheet, and repurchase its shares. All things that bring shareholder value. And today, Verizon shares yield an impressive 5%. Alright, so retirees have a different set of portfolios than younger investors. Specifically, retirees are typically more concerned with the preservation of capital and generating income. As a result, this next stock pick for a retirement portfolio is healthcare giant Johnson & Johnson. Johnson & Johnson has an incredible dividend history, and the company has increased its dividend for over 60 consecutive years, giving it also one of the longest streaks in the stock market. I mean, it too has maintained its long history of raising dividends each and every year, even through recessions. And they could only do this thanks to a diversified and dominant business model. Johnson & Johnson has generated approximately 6% revenue growth and 8% adjusted earnings per share growth in each year in the past 20 years. And it has very large businesses spread across pharmaceuticals, medical devices, and consumer products. Now, as you may know, Johnson & Johnson is about to spin off its consumer division, but it will remain a global leader in two major healthcare categories. And after the spin-off, the company will possess 25 individual platforms or products that each generates at least $1 billion in annual sales. Johnson & Johnson's global dominance is an added competitive advantage. For example, it generates over 70% of its annual revenue from products that hold either the #1 or #2 global market position. And the company's leadership provides it with steady profitability and growth even when the economy enters a recession. And another margin of safety for investors is the company's pristine balance sheet. Johnson & Johnson is one of only two companies, other than being Microsoft, with a AAA rating from Standard & Poor's. Today, Johnson & Johnson stock has a 2.6% dividend yield. And while it's not the highest yield around, it's significantly higher than the S&P 500. And Johnson & Johnson provides one of the safest business models in the entire world, along with a reliable dividend increase each and every year. Now, for the next two companies, we went ahead and polled the audience and found two companies that we thought were really worth mentioning. Actually, they're companies that I probably wouldn't have thought of for this list, but they make a lot of sense. First up, we have Prakash Kohli from Dividend Power's suggestion, and that's Cisco. Now, Cisco is not a stock that many investors consider for retirement income. Cisco designs, manufactures, and sells IP networking and data center hardware and software technologies. And the company spends a significant amount of money on R&D to maintain its leadership by rolling out new and improved products. Now, Cisco only recently started to pay a dividend in 2011, and this year the stock is down about 30%. As a result, investors who buy today, well, they're getting a 3.44% dividend yield, way more than its 5-year average of just under 3%. And of course, as I said before, that dividend yield is more than double the average of the S&P 500. And from a valuation perspective, Cisco is trading at a price-to-earnings ratio of about 15x, less than its range in the past 5 years and within range in the past decade. And as a result, investors seeking retirement income to live off dividends, well, they can get this market leader yielding almost 3.5%, and rest assured that the dividend is probably safe. And last but not least, one of my favorite stores, this one was provided by Craig from Retire Before Dad. He suggested COSTCO. Now, we all know COSTCO is a wholesale retailer operating more than 820 stores worldwide. COSTCO charges a membership fee, providing predictable cash flow and reducing reliance on product profit margins. COSTCO purchases in bulk, like you and I, allowing it to sell high-quality products to customers at an attractive price. Costco also has a compelling inventory model. Instead of filling the stores with every product imaginable, Costco carries only about 4,000 products in its stores, thereby focusing on quality and value while keeping a tidy inventory. And over the past decade, Costco has also increased its e-commerce offerings and sales, but e-commerce is still less than 10% of its total sales in 2021, leaving it much room to grow. At the end of fiscal 2021, Costco had about $12 billion of cash and short-term investments on its balance sheet, and about $8.5 billion in debt. Costco has also grown its dividends for 18 consecutive years. Today, now, the dividend yield is just 0.69%, the smallest on this list. But we have to look that the company has increased its regular quarterly dividend by an average of 12.6% per year over the past decade, and they've also paid 4 special dividends ranging from $5 to $10 per share in that time frame. So if you factor in the special dividends, Costco's dividend yield has averaged around 2.5% over the past decade. Now, if you're wondering how Costco might fare in a recession, well, remember, their membership model and pricing power have helped it power through past recessions, including the financial crisis, as well as the COVID-19 pandemic. All right, so if you're building a retirement portfolio, it's essential to pick the right stocks. Remember, in retirement, retirees need passive income, and that comes in the form of dividends. But before getting started, investors need to research each individual stock before buying to make sure that the payout ratio is sustainable. And this is especially true in an uncertain economic climate. And many high-yield stocks, well, they cut or suspended their dividends in 2020 due to the coronavirus pandemic. So don't forget about that. Now, do you own any of the stocks in this video? Let me know in the comments below why you do, why you don't. In the meantime, thanks so much for watching, subscribing, and I will see you in another video. Bye.